Hi, I'm Jimmy Lepping, psychologist and statistician, and back with another video on financial markets. And in this one, I put to the test using publicly available data from monthly predictions about the Dutch stock market, the assumption that experts can reasonably tell which stocks are going to perform well in the next month and which stocks will not. Using over 300 predictions resulting from survey responses from dozens of experts in each of the past 33 months, I show that there is no evidence that such expert predictions outperform predictions following from simply tossing a coin. So the publicly available data that I used for this research comes from the website you see here, where every month the outcomes of a monthly survey, usually responded to by dozens of experts, are published. This survey presents a series of questions, including which stocks from the Dutch large cap index, the AEX, they think are going to perform best or top, and which ones are likely to perform worst or flop. In the summary of that report, which is in Dutch, you usually see something like, according to the experts, stocks A and B are going to outperform, whereas investors should avoid stocks C and D. Of course, these are quite strong statements, and there are people who actually base investment decisions on such statements, so I think it's important that from time to time we study how well these expert predictions actually perform. So this is what I did in this study. So I took the predictions and outcomes from February 2021, which was the first month I could find data on, all the way until last month's close, so October 2023, which is a time period of 33 months through periods of uptrend, downtrend, and sideways trading for the AEX and other stock indices. From these 33 months, I encountered 161 top and 151 flop or underperform predictions. 161 top or outperform and 151 flop or underperform predictions, hence in total 312 predictions. These were made about well over 25 different stocks in the AEX because although this index only holds 25 stocks, some stocks enter or leave the index at some point. I have here a technical note on the intra-class correlation of predictions, given that almost all stocks had more than one prediction, but the clustering in the data due to that feature was about 0, which means that I can reasonably refrain from difficult, more complex analysis and simply limit to a few relatively simple statistical comparisons to test the assumption that expert predictions do better than tossing a coin. Also note that some stocks were in the top category in at least 1 month and in the flop category in at least one other month, which is of course perfectly fine. Things can happen and conditions may become more or less favorable for a given stock from 1 month to the next. So here we see how these 312 predictions panned out in terms of actual performance. A total of 82 flop predictions were indeed followed by a stock performance of no gain. A total of 69 flop predictions were actually followed by a stock performance with a gain in the next month. A total of 81 top predictions were followed by a stock performance of no gain, and the remaining 80 predictions were followed by a stock performance with a gain. So the good news is that proportionally there was a slight bit more gain in the top prediction category, nearly 50%, than in the flop prediction category with nearly 46%. But how good are these results really? Well, we have statistical methods that allow us to see how much better these expert judgments performed relative to just tossing a coin and basing your predictions for specific stocks on those random outcomes. The black diagonal straight line in this chart shows the expected performance with coin tossing, whereas the red line just over the black line represents the performance by this expert panel. Now, the higher the red line is above the black line, the better it would be for the experts. And well, for the statisticians among us, the area under the curve for the coin is 50%, whereas for the expert performance that is 52%. And when we perform a Bayesian hypothesis test with default priors in the open source statistical programs JASP and Jamovi, we find a Bayes factor above 10 in favor of no difference versus a difference between coin tossing and expert predictions. Of course, we did not only have data on whether a stock gained or not, but we had the actual percentage of gain of any of these top and flop stocks in the calendar month that passed after the predictions. These percentages are also listed on the website in the survey results summary of every month, and I took those percentages from there. I checked them with other sources, but I took them from that website. So here we see in blue the distribution of performance of the stocks that at the end of the previous calendar month received a flop prediction, and in gold yellow the distribution of performance of the stocks that in the survey at the end of the previous calendar month received a top prediction. Depending on how we treat that single outlier at plus 40 something percent in the top group, we find a correlation between prediction and actual stock performance of either around 0.03 or around 0.04, but either way in this interval of values. And in a Bayesian t-test with default priors in the open source statistical programs JASP and Jamovi, we find a Bayes factor above 6 in favor of no difference versus a difference in performance between top and flop classified stocks, which is still fairly solid evidence in favor of no difference. Just to add a bit more evidence of what we call relative equivalence, I report here the 90% confidence intervals associated with the histograms we just saw. For Pearson's correlation, we find an interval from minus 0.05 to plus 0.136, and for Hedges G, we find an interval from minus 0.101 to plus 0.273. These intervals are within boundaries that would receive broad support for what we call relative equivalence, meaning perhaps not exactly equal performance, but a difference in performance that is so small that we might as well consider it more or less the same. Finally, we see here a chart that helps to check if there was any trend towards worse or better performance of top and flop classified stocks over time, but we find no such indication, suggesting that across the time period studied, experts struggled to provide good predictions. This is not to say that we have not seen months of substantially worse or better performance, because there have been, but taking the 33 months together, we do not see a clear trend towards a better distinction between top and flop classified stocks over time. So the conclusion of this study is that it seems hard for experts to predict which stocks are going to do relatively well in the next month and which stocks will not. This is by no means to say that perhaps there were some experts who actually performed much better than others in this survey, because that is a level of detail that unfortunately in the data that we cannot get from what is publicly available. What is publicly available is that the summary of results from the 50, 60, 70-ish experts responded to the survey every month. That said, I think it is important to see that, at least when taken as a whole, this kind of predictions made by a group of experts, and I have no reason to doubt that they did not take this survey seriously, this kind of predictions made by a group of experts does not lead to substantially better results than simply tossing a coin. Both methods would have resulted in more or less the same outcomes, most likely across this period of 33 months. Now, of course, this is just one specific example from the Dutch stock market, so you might wonder if there is any evidence of this kind that experts are not good at stock picking activities like this. And yes, there is scientifically more rigorous work that demonstrates that even if you are an expert in the financial markets, you may not necessarily outperform respondents who are not experts in terms of predictions of which stocks are going to do well and which ones will not. Okay, that's it for this video. Hope this is useful. And if you have any ideas or suggestions for future videos, you can leave a comment below this video or just drop an email at the email address that I have shared below this video. Have a good day and see you soon.